Hi dear traders, last week Wall Street was mainly going through a correction that ended in the red. Such sentiments arose from stronger than expected US economic data, enhancing concerns that the Federal Reserve might further tighten its policy. The stock market opened the new week in positive territory, but investors are still cautious. Markets will focus on key macroeconomic data, including consumer and producer prices, as well as retail sales data, all of which could influence the US Central Bank's monetary policy decision. Stay tuned with us. The financial market is always brimming with surprises. Watch the video till the end and share your opinion in the comments down below. The beginning of the week received a boost from the Federal Reserve as its officials are considering the scenario of not raising interest rates at the upcoming meeting next week. Currently, markets are betting on a 50% possibility of a rate hike in November, following the expected pause this September. Meanwhile, market participants keep a close eye on the incoming economic data, potentially making adjustments to their forecasts. The US consumer inflation expectations for the upcoming year have risen to 3.6% in August 2023 from 3.5% in July. This was the first rise in inflation expectations in 5 months. Apart from economic releases, traders will also focus on reports from major tech companies. Thus, Oracle and Adobe are set to disclose their earnings soon. Tech stocks showed recovery signs on Monday. Tesla shares surged by almost 8% following an upgrade from Morgan Stanley. Qualcomm shares climbed by over 4% after the announcement of their deal to supply Apple with 5G modems for smartphones until 2026. Shares of Meta, Facebook's parent company, rose by nearly 2.5% on reports of its endeavors on a new artificial intelligence model. Financial markets might gain momentum from the forthcoming IPOs of tech giants like ARM and Instacart. According to the CEO of Goldman Sachs, over the next few months, we might witness a significant uptick in activity, especially if ARM and some other IPOs are successful. However, the week's main corporate highlight will be Apple's presentations, where the new iPhone models are expected to be unveiled. As for the key U.S. indices, the Dow Jones Industrial shed 0.75% last week. And in general, thanks to the development of artificial intelligence, the U.S. stock market performance in September may come in stronger than usual. Since 1945, there has been an average decline of 0.7% in early fall. For instance, when the S&P index rises by 10–20% before September, it enjoys gains the following month in 65% of cases, with an average return of 0.8%. If the S&P follows historical patterns, it could gain about 8% by year-end and close at around 4,850. This is not the first positive forecast for the S&P and the overall market. Analysts believe that Wall Street's benchmark will extend gains and hit a new all-time high this year. The index has great upside potential. Stable spending levels, lower inflation, and a possible end to the Fed's rate hiking campaign are among the main contributors to its rally. The upcoming weeks will probably put the record straight. This week's macroeconomic calendar includes inflation data. Next week, traders will receive some clues about the future of the Fed's monetary policy. Economists expect headline inflation to have accelerated to 3.6% last month from 3.2% in July due to higher oil prices. However, the core reading is estimated to slow to 4.3% from 4.7%. Fresh macroeconomic indicators from the US suggest that the economy remains fairly stable. In addition, some Wall Street investment banks have revised down the odds of a looming recession. In this light, there are renewed concerns that the Fed's tightening cycle may not be over yet. Still, markets hope for the August report will not include surprises to shift expectations that the regulator will keep interest rates unchanged at its September 2021 policy meeting. The broad-based S&P 500 index sagged by 1.29%, but started to pay losses this week. By the way, if the Fed does not lift interest rates in September, it will increase the likelihood that the central bank will refuse to tighten policy at its November and December meetings. That's why the stock market now views the rate hiking cycle as completely over, even though Fed officials call for another rate increase. This week, we can outline two key levels of this in the S&P. The first is at 4,430, from which the index rebounded earlier. If the index breaks through this level, bulls will have to turn to safe haven, as the nearest support is located in the range of 4,328 to 4,335. The second important level is the high of 4,541, reached on September 1st. If we see the index above this level, bulls are likely to control the market and push the price towards the resistance level near 4,600. Last week, the NASDAQ 100 index experienced the most dramatic changes, dropping by 1.93%. Most likely, markets are too optimistic about stocks. Meanwhile, investors are anticipating an acceleration in economic growth, which is unlikely to happen this year, considering consumer spending. The potentially weak data on the US economy for September and October are not priced in many stocks and forecasts. The number of stocks contributing to the rally in the S&P and NASDAQ indices remains limited. Against this backdrop, Morgan Stanley is skeptical about possible acceleration in US economic growth, pointing to lower spending. In the autumn and winter, downside risks to the stock market could persist. Some other analysts echo the bank's forecasts. JP Morgan believes that the sentiment in the US stock market indicates a high level of investors' confidence. US stocks have rallied this year on hopes of better than expected economic data and that the US Federal Reserve will soon raise interest rates. Technology stocks were the strongest performers. This was driven by optimism about the development of artificial intelligence-based technologies. This sentiment in the stock market has not yet turned bearish, but it is too difficult to talk about a significant rally at this point. According to Reuters poll, US stocks may show only slight growth from the current levels by the end of 2023. Inflation and high interest rates are among the main risks for the stock market, according to most analysts. Forecasts suggest that the S&P index may end this year at 4,496. You can be sure that the next stock market review will be issued just in a week on September 19th. The InstaForex TV team will be glad to receive your comments, questions, and estimations. We wish you profitable trading. Stay tuned.